Bill Gates liquidated everything, $3 billion pulled straight out of the system. In this explainer, we're analyzing Microsoft, ticker MSFT. Right now, the market is emitting conflicting signals. Some are fleeing, sensing panic. But if we ignore the noise and look at the pure data, disciplined institutional capital is quietly accumulating.
The Bill and Melinda Gates Foundation has entirely liquidated its remaining Microsoft position. $3.2 billion, completely removed. Retail investors usually see a founder's exit as a terminal signal, a reason to panic. But watch the countermove. Activist investor Bill Ackman and Pershing Square are moving in with full force, establishing a massive new core position.
Ackman's thesis is entirely clinical. He explicitly states the asset is, quote, underpriced. He argues the broader market is severely underestimating the absolute utility of the Microsoft 365 suite and their massive AI investments. While retail traders react emotionally to every macroeconomic dip, smart money sees an undervalued AI titan trading at a highly rational 21.8 forward multiple.
Section 1. The AI Profit Engine. Let's look at the undeniable fundamental momentum. Azure is growing at 40%. That's year-over-year growth for their cloud services. This isn't some speculative future promise. It is hard, undeniable momentum operating at a scale that completely defies traditional market gravity.
Annual AI revenue, $37 billion. That's the run rate specifically for their artificial intelligence division. To put that scale into perspective, that's roughly the entire gross domestic product of a small country, just from AI. This is no longer an experiment, it is a highly optimized money-printing machine. Of course, sustaining a machine of this magnitude requires aggressive capital allocation. Capital expenditure has spiked from $16.7 billion to $30.8 billion in just 1 year. That's a near 85% surge. Bears want to classify this as a dangerous drag on cash flow. They're misinterpreting the data. Microsoft isn't just spending, it's an aggressive moat-building exercise. They are outright buying the physical infrastructure of the AI revolution.
The ultimate objective of that infrastructure spend is this figure right here, $200 billion. Macro projections indicate that enterprise AI revenue will jump fivefold to hit this mark. By expanding their compute capacity today, Microsoft is deliberately positioning itself as the toll booth for the entire digital economy. The takeaway is simple. You cannot participate in the next decade of technology without paying them a fee.
Section 2. Short-term technical setup. Let's analyze the mechanics of the current price action.
Price $421.92. Following a significant market correction that bottomed out in late March, the short-term trend has officially shifted bullish. The asset has stabilized and it's beginning its climb.
The price sits comfortably above both the 10-period exponential moving average at $413 and the 50-period simple moving average down at $399. That 50 SMA is currently acting as dynamic support. However, we have to note a deceleration in momentum here. The MACD is still positive, but it is slowing down. The pure velocity of this recovery is cooling off.
Section 3. The 200-day wall. But above all this, a wall is waiting. An existential threat to this relief rally. $461, the 200-day moving average. This is the front line of resistance. Make no mistake, until this thick, blood-red line is decisively broken with volume, the long-term trend remains technically bearish. What we're experiencing right now is merely a relief rally inside a broader structural downtrend.
Section 4. Macro gravity and risks. We have to look at the external economic forces pulling down on the valuation.
The risk? The broader environment is increasingly hostile to mega-cap technology. Bond yields are surging. Inflation is proving to be incredibly sticky. Add in serious geopolitical volatility, and you create a macroeconomic gravity that actively fights against Microsoft's growth multiple. When Treasury yields rise, the present value of future earnings compresses. It's not a theory, it's a mathematical certainty.
This external pressure amplifies the core fundamental bear case, the CapEx trap. That's the danger of aggressively expanding physical infrastructure without the immediate realization of earnings. If enterprise AI monetization slows down even slightly, that $30 billion infrastructure spend is no longer a protective moat. It suddenly becomes an incredibly expensive, depreciating liability that will just strangle their free cash flow.
Which brings us to the ultimate psychological and technical floor, $400. If we slide below $400, the fundamental data we just discussed stops mattering. Pure market mechanics take over, and a technical bleed back down to the March lows becomes highly probable.
Section 5. Final verdict and strategy. Let's lay out the emotionless, systematic trading plan. Here are the exact parameters. Accumulate on dips near the 50-day moving average, specifically $399.06. The target is the 200-day wall at $461, and the hard stop loss is set at the March lows, $356. If the system breaches 356, the thesis is invalidated and the position is cut with absolute finality.
Verdict: overweight. This final portfolio allocation balances the high-conviction fundamentals of their AI monopoly against the very real macroeconomic volatility. We deploy capital here, but we utilize strict downside parameters.
The transition to an AI-driven economy is not a short-term trade. It's a complete rewiring of global enterprise infrastructure. AI is a marathon, not a sprint. Watch the system.